Hey guys, and welcome back to another video. And today, as you can see on your screen right now, we're going to be talking about target date funds. Now don't click off quite yet because there's actually a super good chance that you own some of these and don't know it. We're going to get into that in just a minute, but these are also called life cycle funds or target retirement funds. You may have heard of one of those as well. We're turning this into a little bit of a series. We've already uploaded a video discussing the disadvantages of target date funds. We're also going to be uploading one about the advantages of target date funds. And this video is going to be a little bit more of a recap just about what they are and sort of what their purpose is as an investor. Now, here is what I was talking about with the fact that you might be invested in one of these target date funds and not even know it. There's around 60 million people with a 401k, and almost 60% of them are invested in a target date fund. So chances are, if you're watching this and you have a 401k, you are invested into one of these funds. The reason why so many of these people are invested into them is the fact that many 401k plans automatically invest in target date funds if you don't specifically allocate your funds to other options. Now, this honestly isn't a bad thing at all. It's actually a super good idea to have it automatically invest into these target date funds. One of the greatest advantages of them is that you don't have to do anything. And so if someone's just going to throw their funds into a 401k and forget to allocate it to other options, a target date fund is super general, but as we're going to explain in just a second here, it's also something that helps investors invest almost automatically. Let me go ahead and explain just a little bit more here. The purpose of a target date fund, or the way it works, is that the older you get, the closer that you get to that target date, your portfolio allocation is going to naturally evolve. And so as you go from a young investor to a little bit of an older investor, your target date fund is going to automatically switch from being full of stocks or even more majority stocks, and it's going to slowly buy more of things like bonds, things that are a little bit more conservative, so that as you get closer to that target date that's likely going to be for retirement, you're going to switch to lower volatility, lower risk options like bonds, but they also return less. So you have that accumulation stage when you're younger, buying lots of stocks, a little bit higher risk, but a little bit higher reward. And then as you get closer to your target date of retirement, your portfolio is going to naturally become safer to more assure the fact that your money will be there when you need it. Here's a graph that visually explains what I was just talking about, and then we're also going to go ahead and have a look at two specific Vanguard target date funds that will let us see sort of the percentage of how things work in the real world. But you can see when you're young, around 45 years from your target date, it's going to be a large majority of US stocks, international stocks, things that are a little riskier. You see there's zero cash because this is the accumulation stage where you're trying to make that money that's going to allow you to retire. You can see though that as time goes on and you get closer and closer to this target date, the stocks percentage is going to drop and things like bonds are going to begin to increase. And this becomes even more extreme after your target date. After you're retired, you can see they even start to hold on to things like cash. Stocks are very low, below 40% in total, and you're holding a lot of things like bonds and TIPS, or Treasury Inflation Protected Securities. Now, one more time, the reason why you would want to do this is because when you're young, you're trying to make your money to retire, and when you're already retired, you want a little bit less risk, a little bit less volatility, because you're gonna need that money now. You can't really afford to just have your whole portfolio crash if the market happens to flip to a bear market. So let's go ahead and compare two different target date funds. We're gonna be starting off with a 2070 retirement fund, something that you wouldn't be investing in unless you still have a lot of time in the market and you're still in that accumulation stage like we talked about earlier. A couple key things to keep in mind. There's around a 0.08% expenses fee, and there is a 13.29% year-to-date return at this moment. That's something to keep an eye on that we're also going to look at in this other fund. Now, in terms of asset allocation, as we know from that chart we just looked at, there should be a lot of stocks involved because we're still a whole bunch of years out. And we can see that that's true. 54% in US total stock fund, 36% in international stocks, which for me is a little too high. But then we have 7% in US bonds and 3% in international bonds. So only around 10% bonds, and the rest is all stocks. Let's compare that to a 2030 retirement fund, something that you're going to invest in when you're getting close, just over 5 years out. One thing you might notice is that the risk dropped down to a 3. The expense rate stays the same, but when the risk drops down to a 3, the returns are also naturally going to drop. This fund has only returned closer to 10% on the year versus the 13% that the 2070 fund was returning. We're also going to see a large difference in the allocation of the funds, with there being a lot higher amount of bonds. It's not super extreme, but it's definitely much higher. We have around 40% in US stocks, around 25% in international stocks, and we now have 25% US bonds and 10% international bonds, significantly higher, and that's why the return is going to be a little bit lower because we have those bonds that are much safer, but much lower reward. Now, one sort of sneaky or clever trick that you could do if you want to invest in a target date fund, but want to be a little bit riskier or a little bit more conservative, is to buy a different year than when you're actually planning on retiring. For example, say you are planning on retiring in 2030, but you want to be a little bit riskier. You don't want to move to bonds quite so fast. An option for you could be to buy, for example, a 2040 fund. You can see here that the 2040 fund is still only at about 21% bonds, versus if you remember with the 2030 fund, it was already up to 35%. You could also think about doing this the other way around. Say you're planning on retiring in 2040, but you don't have quite the risk tolerance that other investors do. You could then go ahead and buy a 2030 fund, which has already switched over to bonds much more than the 2040 fund, and then your money will be far more secure, but also will be returning less year to date. One thing that you almost definitely don't want to do, however, is buy multiple target date funds. These are already what we call funds of funds, meaning that there's many funds in just one target date fund. The amount of diversity involved in buying just one of these is already far more than enough, meaning that there's no reason to be buying, say, a 2070 target date fund to help with your accumulation stage, and then also buying a 2030, which is already full of bonds. Your purpose of investing is either going to be one or the other, or if it's somewhere in between, just buy a 2050 or a 2055. There's no reason to be buying different funds with super different target date years just to diversify even more. The whole purpose of this also is that it's going to automatically switch as you get closer. So once again, absolutely no reason to be buying different funds to help you diversify. I hope you did go on to enjoy today's video. I hope you learned something new or that you solidified the knowledge that you already had. If you have any questions about what we've talked about today, or just in general, make sure to leave your comment down below, and we might even make a video about a topic that you suggest. While you're down there, make sure to leave a like to show your appreciation, and subscribe so you don't miss any more videos like this one. But other than that, we'll see you in the next one.